Our next guest, that's Jenny Horne, markets correspondent and co-host of Next Gen here on the Schwab Network. We've got some breaking news on the economic front. Fresh CPI data in. It looks like that headline number is coming in line with expectations. Jenny, break down the numbers for us.
It is, and so far seeing a pretty positive reaction, at least initially in the major indices here, as we did see a rise that, I mean, what, like you said, was pretty much in line with expectations. We do know that what we saw from now the last 12 months, all items did increase about 2.7% before being seasonally adjusted. But all things considered, I mean, I do think that there was such a focus on this print, especially regarding PPI yesterday, because there's just typically more attention paid to CPI, frankly. So right now, what we know did come in slightly softer than expectations. Well, overall, the index for shelter, which does still account for about 40% of the monthly increase, was a major component and a major contributor to this report. Actual number came in around 0.4%. That was exactly in line with expectations, but again, did signal some pace of right now increasing inflation, which is not exactly what the market wants here. All things considered, again, though, I think that when you break down the individual components, a lot of the same sentiment we heard already, again, from PPI, I know the different reports, but frankly, the fact that we're still seeing food costs remain elevated, we're still seeing a lot of these figures remain elevated, especially on a 12-month basis, and the fact that core rose up around 0.2% for a 3.2% gain versus the 3.3% gain last month, that was actually slightly better than expected for core. Energy prices, though, did contribute to the overall CPI print. Well, the owner's equivalent rent, again, which was shelter and all that component, was up about 0.3%, slightly higher than what we saw last month. So I do tend to watch energy and shelter as they do remain some of those interesting and sticky components of the CPI print, Diane. But there's a lot to look for here, especially, again, when you think about the potential of this second wave of inflation, which many don't believe is coming, but today's number does definitely then raise some question marks.
Yeah, but what is interesting to watch right now is the direction of futures after this print. You're seeing a return to risk on. You're seeing S&P futures up more than 1% at the moment. They were already ticking higher when we got the bank earnings in, but it seems like this kind of sigh of relief, especially after that PPI that came in yesterday that was cooler than expected. Now CPI coming in line, 0.4%. 2.9% year over year. So it's interesting to watch this. I think that we do pay attention to shelter. Obviously, that's the biggest component within this. It was up 0.3%. That matched the move that we saw in the previous month. So at least it wasn't an increase in terms of shelter. Is there anything else that stands out to you from the latest inflation data, Jenny?
You know, frankly, I know this isn't maybe the most watched metric, but when you break down the individual components, especially because I think as a consumer, you frankly do care about the way that inflation looks in a broader scope on a 12-month basis. So some notable increases were actually transportation services, which was up 7.3%, as well as, again, shelter 4.6%. Medical care services rose again now, so also remaining elevated. That was up 3.4%. Now, notable declines, which I do think are also important to watch here, were some of these energy services. Specifically, though, fuel oil was down about 3.5%. Well, then, about 13.1% was the contraction there. While energy services were actually modestly higher, 3.3%. But then within gasoline, that was also down almost 4%. And energy commodities were also lower. So you break down some of the individual components, you can see why we're only modestly upticking on a month-over-month basis. Right. But I do think that the 12-month picture illustrates more of some of these trends we look at in the macro front.
Yeah, and I think it's clear why we strip out those more volatile components of food and fuel, because those can really, move differently month to month, especially like you look at energy. In November, it rose just 0.2%, whereas in December, it's a big jump up, more than 2.5%, 2.6% to be precise. But that's clearly one we'll be watching, especially given the direction of both nat gas and crude oil recently. Food away from home, just increasing 0.3% in December after that bigger increase in November. So I'm sure for consumers, that's a step in the right direction in terms of the increase being less than expected. But overall, again, Jenny, it's interesting to see this move in the markets that we're seeing, especially given how jittery the markets had been ahead of this inflation print. But I know you're watching a couple other headlines for us this morning. You've got Adobe in focus as well, off the back of an upgrade. What's the latest here?
I know a name that has, I think, fallen out of favor a bit with some of the sell-side analysts, but now at least getting some positive news out of Exane BNP, which upgraded shares to neutral from underperform with a $425 price target. They mentioned, though, that the stock's valuation now prices in Adobe's near-term risk of this rising competition from these creative apps. And they did also say, as such, they now see an improved risk and reward and think that shares may find, hopefully, some near-term support with management seeking to address some of these near-term concerns. As we've said with Adobe, it's not going to be the rising tide that lifts all boats when it comes to the AI benefit, frankly. I think that their competitive moat was the difficulty to use these various apps. I've been making the argument that now you add AI, it tends to make it maybe just more accessible, which seems like a good thing, yes, but then it eliminates then somewhat of their edge. So kind of a double-edged sword there. This name, though, has contracted now about 31% over the last 12 months and does now remain down about 7.2%, at least through Tuesday's close on now the month. Well, actually remaining elevated on the week, up about 1.7%. So a bit of a mixed picture, but they again highlight that this risk and reward improvement, you'd hope, because we're pretty much, I mean, this point, we're off of lows by about 2%, but gosh, a pretty blistering chart in Adobe, which was one of these really early winners of the AI hype cycle.
All right, and then we got Tesla in focus as well this morning. We got some sell-side analyst activity around it, one of those being Barclays. What's the latest here?
There's always news on Tesla. I know we discussed Elon Musk's potential title every day. Every day there's news on it. I guess it makes our job easy. But Barclays was one that raised its price target to 325 from 270 with an equal weight rating, saying that they see several key areas dominating their business focus for 2025. Some of those being the return to volume growth, the expansion in autonomous vehicle efforts, and contribution from other areas, which notably are expected to be some of these regulatory credits and energy. However, they do believe that fundamentals remain secondary versus the broader theme of narrative command for Tesla, which has gone into hyperdrive since the U.S. election, of course, which we know that Elon Musk poured a ton of money into, but his net worth has risen so substantially, I mean, tied to Tesla's run-up in share price, that now I do think that this analyst makes a good point, saying that it's become unweathered from its fundamentals, arguably similar to what we saw with the stock back in 2021, which was then when we saw that substantial pullback. Thankfully, I do think some of this pressure has been a bit more gradual. Well, the street, though, is so mixed on this name, as always. Wells is another one with an underweight rating, $125 price target, saying that actually, really, the fundamentals remain weak, and they do believe the Inflation Reduction Act repeal remains a material risk to its demand and its margins. I think that's huge. We always say that Musk is going to be a beneficiary of his ties to the new administration, but there's also major components of their business that will be hit, of course, from the expected Inflation Reduction Act repeal.
Well, today, right now, shares are higher in the pre-market, so we will see if that continues to be the case throughout the balance of the year, especially following the inauguration with his relationship with soon-to-be President Trump. Jenny Horne, great insight. Thanks for breaking down the latest inflation numbers and some of the sell-side activity we're seeing around Adobe.